Personal loan. A personal loan is a general-purpose loan that you can use for almost anything. It is usually offered by banks, credit unions, or online lenders. You borrow a fixed amount of money and repay it in equal monthly payments over a set period. Interest rates depend on your credit history and income. What makes it different is its flexibility. There is often no requirement to explain exactly how the money will be used. It matters because it provides structured access to cash for emergencies, large purchases, or debt consolidation. Mortgage loan. A mortgage loan is used to buy real estate, usually a home. The property itself acts as collateral for the loan. If payments are not made, the lender can take the property back through foreclosure. Mortgages became common as homeownership expanded and long-term financing made houses more affordable. They often last 15 to 30 years, with either fixed or adjustable interest rates. They matter because they allow individuals and families to purchase property without paying the full price upfront. Auto loan. An auto loan is specifically designed to finance the purchase of a vehicle. Like a mortgage, the vehicle serves as collateral. Loan terms are typically shorter than home loans, often ranging from 3 to 7 years. Interest rates vary based on credit score and whether the car is new or used. Auto loans grew alongside the expansion of the automobile industry. They matter because they make transportation accessible while spreading the cost over manageable payments. Student loan. A student loan helps pay for education expenses such as tuition, books, and housing. These loans can come from governments or private lenders. In many countries, government-backed student loans offer lower interest rates and flexible repayment options. Repayment often begins after graduation. Student loans became more common as higher education costs increased. They matter because they open access to education, though they can create long-term financial obligations. Home equity loan. A home equity loan allows homeowners to borrow against the value of their property. It is based on the difference between the home's market value and the remaining mortgage balance. The loan is paid out as a lump sum with fixed payments. It became popular as property values rose and homeowners gained usable equity. What makes it different is that it uses existing ownership value as collateral. It matters because it can provide lower interest rates compared to unsecured loans. Payday loan. A payday loan is a short-term, high-cost loan designed to cover expenses until the borrower's next paycheck. It usually involves borrowing a small amount for a very short period. Approval is often quick and requires limited credit checks. However, fees and interest rates can be extremely high. These loans emerged to serve people with limited access to traditional banking. They matter because they offer fast cash, but they also carry significant financial risk. Business loan. A business loan provides funding for business activities such as expansion, equipment, or operating expenses. It can be offered by banks, government programs, or private lenders. Approval often depends on the company's financial performance and business plan. Some loans require collateral, while others rely on projected revenue. Business lending has existed for centuries as trade and commerce developed. It matters because it supports entrepreneurship and economic growth. Credit builder loan. A credit builder loan is designed to help individuals establish or repair their credit history. Instead of receiving the money upfront, the borrowed amount is held in a secured account. The borrower makes regular payments, and once the loan is fully paid, the funds are released. This structure reduces risk for lenders. It matters because it creates a record of on-time payments, which can improve credit scores over time. Debt consolidation loan. A debt consolidation loan combines multiple debts into a single loan with one monthly payment. It is often used to replace high-interest credit card balances. The goal is to simplify repayment and possibly secure a lower interest rate. These loans became more common as consumer credit expanded. They matter because they can reduce financial stress and make debt management more predictable. Secured loan. A secured loan requires the borrower to provide an asset as collateral. That asset could be property, a vehicle, or savings. Because the lender has protection through collateral, interest rates are often lower. If payments are not made, the asset can be seized. Secured lending has been part of finance for centuries. It matters because it allows borrowers to access larger amounts at lower cost, but it also increases personal risk. Unsecured loan. An unsecured loan does not require collateral. Approval is based mainly on creditworthiness and income. Because there is no asset backing the loan, interest rates are usually higher than secured loans. Personal loans and credit cards are common examples. They matter because they provide access to funds without risking property, though they depend heavily on credit strength. Fixed-rate loan. A fixed-rate loan has an interest rate that stays the same throughout the entire repayment period. Monthly payments remain consistent from start to finish. This structure became popular because it offers predictability. Borrowers know exactly how much they will pay each month. It matters because stability can make long-term financial planning easier. Variable rate loan. A variable rate loan has an interest rate that can change over time. The rate is usually tied to a benchmark or market index. Payments may rise or fall depending on economic conditions. These loans can start with lower initial rates compared to fixed loans. They matter because they may reduce costs in certain environments, but they also introduce uncertainty.